Okay, hi everyone. Welcome to today's IMIM seminar series. Today we are very happy to have Professor Zhiyu from Washington University in St. Louis. Her field is mostly asset pricing and international finance. Although this is the first time that she presented a paper at IMIM, but in the past, we have her courses to present her other two papers before. So we are very happy that she can present her paper today. The paper she will present is titled as A Bond on Price Impact and Disagreement. And we are also very happy that Professor Erik Loualiche will serve as the discussant. The presentation time will be 50 minutes, and then this will be followed by the discussion from Professor Loualiche. And then, like, without further ado, I'll let Julio get started.
Okay, thank you so much for the introduction, and let me get started on the talk. It's called A Bound on Price Impact and Disagreement. I co-authored with Philip and Lorenzo. Okay, so let me start by a very uncontroversial statement, which is investors are highly heterogeneous. They disagree in beliefs, they have different preferences, they have different regulatory constraints, etc., etc. Now, just to pick one term and to be concrete, hereafter we are going to refer to all these form of heterogeneities as disagreement. But I want to stress here, when I say disagreement or agreement, we don't simply talk about beliefs. We talk about all forms of heterogeneity across investors. And because of the disagreement between investors, we observe very heterogeneous portfolio holdings across investors. Different investors have very different holdings, and we observe the flows between investors in a form of trade because they disagree. That's a very uncontroversial statement, and I don't think anyone will disagree that investors are largely disagreeing with each other. But let me follow with a controversial statement, which is holdings and flows matter for asset prices. Now, for people who are not actively participating in this debate, it's actually quite a large debate nowadays. There are two sides. The elastic market view holds that holdings and flows don't matter for asset prices, while the inelastic view holds that actually holdings and flows matter a lot for asset prices. Now, for those who are not in this field, you may wonder why this is an interesting debate at all. Why do we want to care about whether holding and flows matter? Or if you have heard about the term elasticity debate or multiplier price impact debate, why the number of elasticity is important at all? And I'll argue that this is fundamentally important for the methodology we have to approach asset prices. Fundamentally, it speaks to the methodological question that can we understand asset prices from quantitative data at all? If the market are inelastic, then flows and holdings contain important information about the underlying asset prices. And we should look into holdings and flows to help us to understand asset prices. But if flows and holdings don't really matter, then if the market is very elastic, then holdings and flows are just a sideshow. Then in order to understand asset prices, we can just construct SDF purely based on the price data, and we're good. Okay. Now, here is how this paper comes into picture. In this paper, we argue that given observable moments, sigma p, the price volatility, and sigma q, the quantity volatility, the flow volatility, if one acknowledges investors disagree with each other, one must accept that flows have large price impact. This is the main point that we're trying to make in this paper. And in my experience presenting this paper, at this stage, most people will be thinking, what am I talking about at all? This nonsense. Hopefully, in the next slide, I can convince you that in this argument actually is quite intuitive. So let's keep a track. Okay. The starting observation of this paper is that prices are very volatile, but portfolio flows in the market are actually very small. So we have very high sigma P while we are having a small or comparable sigma Q. This gives us a fundamental tension between investor agreement, rho, and the price impact, M. To see the tension, let's start from a very simple and standard scenario. Let's see investors largely agree with each other. There's a high agreement. Then in that world, it's very easy for us to reconcile high volatility in price while very little or even no trading. We're back to the representative agent world, and the no trading theorem apply. Everyone agree what the SDFS, everyone agree what the cash flow is. We perfectly know the stock price. Stock price is super volatile, but there doesn't need to be any trading because we all agree with each other. Trade only reflect heterogeneity. But suppose we step away from the high agreement world. We're in a world where investors disagree with each other a lot. Then this will lead us to think that we should expect there's a lot of tradings across investors. If people disagree with each other, then they should trade. But the flows are very small. And even though the prices are very volatile, so I disagree with what the right market price should be. The market price changed a lot over time, and I don't trade against it that much. The flows are small. Then this begs the question, why? And the natural conclusion from this is that it must be that investors are insensitive to the price, such that even though I disagree with what the right price should be, and the price has moved a lot, I still don't trade that much. In other words, investors are inelastic to the price. Meaning, if there is a flow into the market, it really takes a quite large price adjustment as a price to induce me to get into the market to take the opposite position. So the flows will have large price impact. Now, this is the most important slide of this whole talk. So let me go through the logic again to make sure everyone's on board. The starting observation is that prices are very volatile and portfolio flows are very small. And the tension is if investors agree with each other, that's fine. It's very easy to reconcile. Flows are small while prices are volatile. But if investors disagree, while they don't trade against the prices move around all the time, very volatile. I disagree what the right price should be, but I don't trade against it. And then the natural conclusion is I'm insensitive to the price movement. So if there's a flow into the market, I really need the price to move quite a lot for me to take the opposite position. So flows have large price impact.
So I think the idea is if you allow for disagreement to reconcile this high volatility of the price, you need to have the inelastic demand, right?
Right, exactly, yes. If you're in a representative agent world, totally fine. Then the flows can be as small as zero. Everyone agree, no trade theory holds. But suppose you believe investors disagree, then you have to acknowledge that they can be sensitive to the price, because otherwise you will see much larger flows. And then I'm going to convince you that yes, under any reasonable estimates of investor disagreement, the market is pretty inelastic. Right. So what this paper does is to formalize this tension in a statistical bound under fairly general assumptions. And the bound is given in this formula, and I'll unpack the formula in the next slide. But so this slide is really the main point of this paper. So for now, if there's any question, I'm happy to take any question from now.
So what is the M?
I'll explain it in the next slide. Here, okay. So what this bound does is that it connects two observable moments, the return volatility, sigma p, and the flow volatility, sigma q, to agreement, rho, and price impact, m. Rho, very loosely speaking, you can think about it as a correlation in demand shifts. And the key word is shifts. Demand shifts is defined as any change in portfolio choice, fixing the price. And we are focusing on changes. And so we're not talking about the level disagreement or agreement of investors. What is the right price level of Apple? We're talking about over this quarter, how much do people update their belief about Apple? And we're talking about the agreement for that object, the update. And M is the percentage change in price due to 1% demand shifts. Okay. And so in several slides, I'll go through how we arrive at this bound. But for now, let's take it at high level just to get a sense of the intuition of the bound, or what it says.
Hey, Julie, can I interrupt you just for a second?
Please.
Like, why do you want to call this a bound rather than just like, why do you want to put an inequality sign rather than equal sign?
Because
you could just say, because we
Mhm.
do derive the equality sign, and then you could just say, oh, I have the equality sign, but there are multiple reasons for why, I'm gonna be conservative. And
Yeah, it's more just because it's more be conservative. Because inequality, the equality sign is derived under a stronger assumption, which I'll explain later, essentially homogeneous elasticity. But once we relax it, then the equality do not hold, and it all becomes a bound. That's the reason we talk about bound.
And the other thing, like again, like since I'm gonna discuss later, feel free to defer, but like can you say a little bit more, you did mention the no trade theorem. Like, can you say a little bit more about like how this kind of relates to no trade theorem, and then basically how like you're trying to find deviations, sorry, from the null of the no trade theorem.
Right. Yeah. So the no trade theorem, if we can think about conceptually, we can think about the representative agent framework in this framework as well. In this way, then everyone will essentially agree because it's a representative agent. So we are going to bring rho to 1. And in that world, as you can see, the bound doesn't really have a bite. If we bring rho to 1, and in the representative agent world, sigma q goes to 0. So in this world, there's not that much. The bound is kind of in the kind of singular point. It doesn't say too much about it. But once we're deviating from there, then in the case when the rho is particularly close to 1, and sigma q is particularly small, R bound will not be particularly useful in that area, in the sense that this is very close to 0, this is also very close to 0, and these are two infinitely large numbers multiplied together. We don't see much about it. But the nice thing about the bound is that it's largely flat in the middle range. So here what we do is that take for every US stock, the volatility of P is 20% for quarterly frequency, and Q is also 20% for quarterly frequency. So this ratio is around 1. And suppose we exactly don't know anything about rho, the correlation, the agreement between investors. We can still plot this bound on this as M as a function of rho, and then shaded area are the admissible range for the bound. For the middle range of the agreement, when the agreement is between 0.1 to say 0.8, the bound is pretty flat, meaning that we don't need to pinpoint what exactly is the agreement level rho for us to get a pretty good ballpark estimates of the multiplier. But as the rho goes to some extreme values, if it goes to 1, where the no trade theorem is more and more applicable, then R bound is not that particularly relevant. It's not super informative. But what we are going to argue in this paper is that we can measure rho in all sorts of ways, And typically, the range you can find is between 0.1 and 0.75-ish, which will gives us the price impact between somewhere 1 to 3. And who else thinks the price impact M is around 1 to 3? Virtually every other event study-based identification of M falls into the empirical studies, falls into this range between 1 to 3. Okay, Eric, does that answer your question, or you're muted?
Sorry. Yes, kinda. I'm asking questions as in like I think could sort of like hopefully benefit the audience, but also just to clarify, how does it relate to things we know. So yeah.
Okay, thank you.
I mean, obviously I have more questions and disagreement about like the x-axis here, but we'll get to that.
Sounds good. Okay, perfect. Okay, so that's the visualization of our bound on the individual stocks. Now, what can we do with the bound? The price impact bound is largely model agnostic. The major tool we rely on is log linearization of a generic portfolio choice problem, which follows a long tradition in asset pricing. And we only impose pretty weak structural assumptions on demand shifts and elasticities. We don't try to microfound elasticities or microfound where demand shifts is from, but we take more an agnostic view, and we argue that under the generic assumptions we make, then the bound should hold. So it serves as a pretty good diagnostic tool for developing structural models. For theories, we can apply this bound to see the trade-off between heterogeneity and elasticity when we take the model to match the volume as well as the price volatility data. And for empirics, if you are very deep in the demand camp and already believe the market is very inelastic, then this bound further provides a very simple and transparent metric for price impact. It can give you a sanity check for estimates. Sanity check for the estimates from event studies. Say we run some event studies for, say, foreign exchange. Sorry, 1 second. Okay, say we run some event study to understand how much is 1% flows into the foreign exchange market and move the USD. And we get some number. How do we know whether the number makes sense or not? We can apply this bound to get a sanity check to see what kind of the row or what kind of the hidden assumptions we need to have to justify the magnitude of the price impact. And for those case scenarios where it's harder for us to find the event studies, we can use the bound for a ballpark estimates to get a sense of how large the elasticity, the price impact should be. And we're gonna give you some examples in the end of this talk about those ballpark estimates. But now, without further ado, let me go into how do we derive this bound so that people can give a better sense on what am I talking about. So the model framework we're using is a pretty general framework. Take any portfolio choice problem, we log linearize them. We have delta Q as a function of delta P scaled by zeta. Zeta I is a price elasticity for investor I. And UIT is the demand shifter that moves the portfolio choice problem when we fix a price. Now, this formula can be microfounded in multiple ways. We can think about standard CRA. In a standard CRA, we have the classic mean variance portfolio choice problem solution, and we log linearize it. We can get delta Q as function of delta P. The classic CRA will predict homogeneous elasticity, and elasticity is determined by the average expected return and the risk-free rate. And the U comes from multiple sources. It comes from the expected changes in the future cash flow. It comes from changing your wealth. It comes from the risk aversion. They all enter the demand shifts. And it is well known that the elasticity from the standard CRA is typically very high, and which is counterfactual as suggested by the empirical estimates. And there are many models developed already actually to understand the price impact of flows. And one of the more very classic approach is to suggest that investors learn from the price. And once investors base their future expectation on the to learn that from their own signal as well as the price, then they will, when the price increase, they may not be so willing to take the opposite position because they will be thinking probably the market knows something that I don't. And once you have that, plugging back in the we have demand shift equations specifying this way, the elasticity now becomes the CRA elasticity times your how much weight you put on the price versus how much weight you put on your own signal. And then the U comes from your private signal about the future cash flows. Okay. And oops, do I have more? Oh, and these are, sorry, hold on. These are just two examples, and we do not want to say that our model is built on that. Potentially, there can be many other micro foundations, such as portfolio adjustment cost, regulation, and many other different portfolio choice problems. Take that problem, we log linearize it, we can always write them as a linear demand curve. And it also doesn't need to be static. It can be perfectly dynamic. In the dynamic world, still we can the portfolio choice problem depends on the current price, but here is no longer the simple next period dividend, but also the next period price, or actually, in fact, the whole expected price sequence in the future that is deviating from the market average. Okay, so that's the micro foundation part. But now let's just play around with the demand curve. And purely for illustration purpose, let's start with homogeneous elasticities. We have delta Q as a function of delta P with homogeneous elasticity plus the demand shifts. Market clearing condition specifies that all the flows sums to zero. Because delta Q is a percentage flow, we use S to denote the ownership share of each investor's share in the stock. So delta Q after ownership share weighting sums to zero. That's a market clearing condition. And the market clearing pins down the price. Now the price will be the aggregate price impact, which is 1 over the elasticity times UST, the demand shifts, and the aggregate demand shifts, which is the size-weighted individual demand shifts. Or you can think about it as the average, the size-weighted average demand shift in the market. Okay. Now, delta Q in this case has a very simple solution. Delta Q, the flows will be exactly your demand shifts minus the average demand shifts. So delta Q in the homogeneous elasticity world exactly captures your disagreement with the market. Okay. Now we can take a look at the Now we can take a look at the variance of these two objects. The variance of the price is very easy. M squared times the variance of the total average demand shifts out there. The variance of Q is a little bit complicated. It is empiric shock variance, your own shock variance times plus the aggregate shock variance and then the covariance terms. This is a little bit complicated, but the key insight of this paper is that let's look at the average flow volatility. It's sigma Q squared, which is the size-weighted individual investors' flow volatility. Then this one has a very nice formula. For people who are fast at econometrics, you can immediately see that if we size-weight this guy, it'll becomes another variance term, aggregate variance term. And after manipulation, we can derive sigma Q squared, the average flow volatility, as the aggregate demand shifts volatility times this object. And here rho is variance of the US, the average demand shift volatility, divided by this object. Now what is rho? Rho essentially is, we call rho investor agreement. It is R squared of the demand shifts explained by cross investor average. Why it's an R squared? Because the denominator is average variance of demand shifts out there. And the numerator is the variance of the average demand shifts. So this is literally the share of the variance across investors explained by the average across them. This is R square. This is a measure of the agreement. And in the homoscedastic case, the R square is also exactly the average pairwise correlation of the investor demand. Okay, so what this formula says is essentially that the rho show up here is that because this literally is the variance share. This is the variance share of, can you guys see this part? It's hidden a little bit below my dog bar, but I hope you can see it.
Yeah.
Good. Okay, perfect. Okay, so this one is literally the share of the aggregate share of the average demand shifts among all the demand shifts. And why it enters here? Because this is the ratio. This is the sigma Q, which is the flow volatility, is the share of the disagreement part. And this row links the share of the variance of the unobserved average demand shifts to the observed flow volatilities. Okay. Now, taking these two equations together, we have, you can immediately see where the bound is coming from. We have sigma p squared, which is m squared, the price impact squared, times the variance of the underlying aggregate flow volatility, aggregate demand volatility. Sigma q is the heterogeneity or disagreement times variance the total demand shifts volatility. Now we take the ratio, we have an equality. The price impact m equals the ratio of sigma p to sigma q, the price volatility to demand to flow volatility, times the disagreement. Okay. If we observe a high p over q volatility ratio, then it means that either the left-hand side is very high, price impact is very high, or a second term has to be low. A second term has to be high. The disagreement has to be high, or the agreement level has to be, did I put it in the opposite way? Sorry, it should be low disagreement and rho has to be very high. Okay. Now to give a bit more intuition on what this bound really means, notice that the rho is the fraction of demand shifts explained by the cross-investor average. And I tend to like to use an iceberg as an analogy. And this iceberg may not be physically super viable, but I think it's actually speaks the core of this idea. So let's consider the total demand shifts, the whole demand shifts out there, as the whole iceberg. The part we below the sea surface, below the sea level, is the common demand shifts. That's a part that we don't directly observe. That is a part that moves the aggregate price. And the one above is the flows, because flows are the part that you disagree with the market. And by disagreeing with market, you trade a service above the sea level and to be observed. Now, and the rho is controlling the share of the common demand shifts relative to the total iceberg. If we are in a representative elastic world, meaning most of the demand shifts are in agreement, meaning most of them are common demand shifts that's below the sea level and we cannot observe them, that's a rho. And in that world, because we observe a small sigma q, small flows, but because investors agree with each other a lot, so we know that underneath the sea level, there's a huge, gigantic iceberg out there that moves the price. So we don't need the price impact to be very large we don't need large price impact to justify high price volatility. But if we are in the heterogeneous inelastic world, in this world, we observe small flows, which we observe the same amount of flow, but because we know investors disagree with each other, it means we know that what's beneath the sea level is not that large. So what moves the price is not that large, while the prices are hugely volatile. It must be that for $1, 1% demand shifts, the price, the multiplier has to be a lot, so that the price volatility to be very large. And this equality in this case, in the homogeneous case, says that we can only live in these two worlds. We're either in a representative elastic world, or we're in a heterogeneous inelastic world. But we can be in a heterogeneous and elastic world. Okay, that's what this bound says.
Now, that's very interesting. I think you explained it very clearly. But
thank you.
Is the word always the same, or it can change? So
which one? The rho?
No, I mean the word. You are saying we can be either in one of the two words, but can this data pattern change in recessions or in expansions? They are different, or they are always the same?
They are, and there are a lot of things to explore using this framework. And we have some early results on that as well. I can quickly mention on the trends on how do things, where are we across time in different scenarios. I talk about that in the last section of this talk. Okay.
Yeah. Hey, Julie, just one question there. Here, there's something that does matter, like the way rho is defined is the actual distribution of investors, right? So this S, which is the SI, is the share of investor I in the asset.
Yes.
And so clearly, if you have like 1 over n, like that's kind of like always the max entropy thing, but if you have like one big investor, that kind of matters. And
exactly.
I guess I was gonna ask you, like, can you speak to that, or like, because I don't think you talk much about that.
I don't talk much about that.
If you look at the row, it's very clear, like S is not like, there's a square on top and no on the bottom, so it does matter quite a bit.
So true, exactly. So all the average is essentially taken under using the size weighted as a density to measure. So the rho is in some sense, it's a dollar weighted agreement, and the larger is investors, the more vote they got in the agreement measure. And suppose we're in a world where there one investor dominate, then we naturally just have a very large rho because this guy's words determines the market. So yes, conceptually this is an important issue. And if we apply it to different markets, then in some markets the huge concentration will be a potential issue. In the follow-up analysis we did in the stock market, in the US stock market, S doesn't matter that much in the sense that we did several exercises.
Well, I actually, here's let me be contrarian here. So first it does, so it does matter. And then so what you call agreement, really what you mean is like how all those UIs lined up. But really what it measures is like how the UIs and the SIs together line up. But the other thing is like if you think, passive investing, is that just like one big S? Yeah, kind of.
It's not that big. And even if you look at the
passive investing
BlackRock. You are saying that, but you are talking about the passive investment as a whole sector. Then that'll be huge.
Of like passive investing as one demand in a way.
That'll be very huge. But suppose conceptually we're thinking about pure passive investing, like there's no flow at all. They just buy and hold. In that case, U is essentially zero. In that case, but that's not because they do not move beyond whatever the price. Exactly. Yeah. And so we do in the estimation, we do factor that in. We can factor that in as well, right? There, US just becomes zero. And wait, this is first thing, and wait, what's the second thing I want to
So
say
okay,
about this?
so sorry, like, but then that means that the sum of SI is one minus passive. Like, I guess it has other consequences. Even if those U's are zero, that means like it's more concentrated than the rest. I just can't really do the math in my head here, but it would have like other consequences. It's not
So
just like
so I agree. It'll increase the homogeneity. It'll increase the agreement in the market. Yes,
okay,
exactly.
yeah, yeah.
Oh, wait. Now I remember what I want to say. Yes, if there's a pure passive investment, then you will just be zero. But in the data, actually, if you look at the flows from, say, Vanguard versus flows from other passive ETFs, there are actually still flows, mostly because of the fund investors. They are not that passive anyway. They are investing in and out, so the flows are still there.
Maybe. Okay, interesting.
Yeah. And
I
and
have
one
a
extra
quick question.
yeah,
So,
please.
like, here you treat this disagreement as a parameter row. So, what if this row is always is also endogenous to this common demand shifter? So, for example, if there's a demand shock, demand shifter happens, then makes investor disagree more. Then, like,
Yeah, I guess it's not that it's endogenous to you because it's literally defined as you, but what you're getting at is rho can be time varying and can be
right.
conditional. So here what I give you is more like an unconditional rho. It can be conditional, and that's totally right. And rho can be time varying as well. So notice that in the derivation of our bound, we never taken, like this bound, we never use any asymptotic theorem or anything. It's just about operator, variance operator and covariance operator. It holds in population, it holds in sample as well. It holds period by period as well. So in other words, we can do it conceptually, we can apply it period by period, meaning we have the equality, this one, which is this period MT equals to this period volatility of P, this period volatility of Q, and this period agreement rho. Conceptually, we can do that. In terms of estimation, then this potentially, like, then how do we do the, like, one period sigma P with period sigma Q? Then that's an empirical estimation problem. But conceptually, we can think about the problem. See, in this period, suppose we see the prices are not that volatile. The prices are not that volatile while volume increased a lot on that day. And we kind of have the sense that the price impact should be holds relatively constant across this kind of short period. Then the natural conclusion in that scenario would be, it's because in this period, rho T has been much smaller. There's much larger disagreement in the market for this particular period. That's why the price is not moving that much, but there's a lot of flows. So conceptually, this is totally applicable.
Okay, thank you.
Yeah. Okay, and so now I've been talking about homogeneous bound. Now let's go to the heterogeneous case. In the heterogeneous case, we have zeta is no longer, zeta is different across investors. So let's make a stylized assumption, and we consider this a neutral benchmark. That is, in the cross-section, the elasticity zeta for each investor is independent from the data generating process for demand shifts U. Because in order to, so for the one particular model, then there might potentially be different ways for the zeta to be generated because of the frictions in the adjustment cost, for example, and U's can come from other sources, etc. And we here for simplicity, let's make a high-level assumption that they're independent. It doesn't
Julie,
need to be. Yes.
Sorry to interrupt, and I'm going to talk about this actually, and so
please. Okay.
And I won't talk much about the data, so you can probably move on to because we don't have much time left. So
perfect. Yeah, I was also looking at it. Thank you.
I don't want us to talk about.
Yeah, great. Thank you. Okay, great. So under this assumption, the price impact is bounded below in this way. So equality becomes inequality, and the intuition is that because now even now the flows are even inflated by heterogeneous elasticity. Even investors agreeing on the demand shifts, they will still want to trade because they have different liquidity provision incentive. And flows are more amplified, then the bound becomes a lower bound. Okay, now let me move on to talk about data. And the data we're using is the 13F quarterly institution portfolio holding. These are the boring stuff, so let me skip it. And how do we measure it? We can measure sigma p using quarterly realized returns and measure sigma q using the following definition. And we can measure using the portfolio turnover as well, but let me quickly skip it. Let's see what does bond look like for the US equity market equity. Rho is not directly observable. But we can still directly plot this one as a function of rho. And we can see that the plot is pretty flat, as I mentioned earlier, in the reasonable range of the rho of the agreement. And across stock, there's heterogeneity across stocks. But as you can see that the heterogeneity actually is also not that large. From 10th percentile to 90th percentile, the price impact move from 0.5-ish to 2.5-ish at around medium rho. Okay, so how do we get rho? How do we measure the investor agreement? Without more structure, we can't really directly measure rho from the flows and holdings, because the whole point that we're arguing is that these capture elasticity as well. So there are several ways to move forward. The classical way to move forward is let's put more structure on it. For example, let's use Coin Yogo to measure the elasticity and then back out the rho from demand shifts. Or let's impose factor structure on U, and then we can identify factor loadings and elasticity jointly. And this is essentially the GIV approach. And here we want to be a little bit more reduced form and model free. What we're gonna do is that let's see we can find the proxy of U's that are not highly endogenous to P. And the point is that we do not want to precisely point identify rho. All we want to show is that rho lies in the median range, such that the bond is relatively flat, that we have a good ballpark estimates. Now the first investor agreement measure we use is the analyst forecast data. And here we make the assumption that the factor structure across analyst forecast are similar as investors. Now this of course is a strong assumption, and in the current revision we actually try to increase test other forms of heterogeneity, not only in the analyst forecast, but all in other dimensions as risk aversion, etc., etc. And the goal is to show that across all these dimensions, rho is kind of reasonable. Okay. Now, what we estimate is we regress the quarterly update of EPS forecast, delta F, on the time fixed effect, and we report the adjusted R-square. And the adjusted R-square of time fixed effect gives the agreement across analysts. And let's see where they line up. The agreement across different horizons of forecast is kind of range between 0.3 to 0.5-ish in the reasonable middle range of this of the bound. And this gives us the elasticity estimates, price impact estimates between around 1 to 2 or 1.5. And as I mentioned earlier, virtually all the existing studies using event study approach to estimate price impact range between 0.5 to 3 in terms of price impact. Put it on bound, it gives us the rho between 0.1 to 0.7 or 8. So they are all in the flat reasonable range of the estimates. Okay. Now I don't have a lot of time left, so let me move forward. Let me skip this one. And here what we did is that we verified that our bound in the cross-section actually is consistent with the event study evidence. When event in the cross-section for stocks with larger price impact estimates from event studies such as FIT or S&P, our bound also indicate that they should have higher the P sigma Q ratio or higher elasticity bound. Anyway, let's talk about a little bit something more interesting, which is how can we use this bound to do things when the event study are not available, or use it to explore other dimensions. Okay, so to do that, we need to make a simple assumption that rho is not too far from 0.5. So we kind of homogeneity is in the reasonable range, so that the disagreement term is roughly around 1. And then in that case, the price impact bound can be simply approximated as sigma p, sigma q ratio. And let's take this PQ ratio to explore different heterogeneities across time horizon and across different aggregations. Now, as I promised earlier that we can use this to explore the time dimension. Across time has the liquidity provision changed. We can construct the PQ volatility ratio at different frequencies. We can construct it at daily frequency, quarterly frequency, annual frequency, and we plot it across time. Now, notice that for quarterly and annual frequency, we can simply aggregate it from the 13F quarterly holdings data. For daily frequency, we don't exactly have the 13F holdings, the holdings for different investors. So it's harder for us to measure the true sigma, the volatility, flow volatility. But at high frequency, the daily volume serves as another proxy for the flow volatility. Because at daily frequency, when the frequency becomes higher, the volatility, there's not that many round trip going on within one day, then the total trading volume will be closer to how much investors rebalance on net in the short period of time. But to be clear, this measure overstate how much flow volatility is in the daily frequency, because potentially there is a lot of within intraday round trips that can inflate the daily trading volume, but still have zero portfolio turnover. With that being said, we can still just do the exercise to see how does things look. And we can see that at the quarterly and annual frequency, the volatility, average volatility ratio across time has been remained largely constant, rather not changed much. And annual is more elastic than quarterly frequency, which is very intuitive and consistent with a lot of estimates out there. At the daily frequency, though, the price impact has used to be very large, and across time, it gradually goes down, and to be comparable to the quarterly annual frequency because of a huge increase in the volume. But because the portfolio net turnover hasn't really changed across time at the quarterly and yearly frequency, the quarterly and yearly frequency liquidity has not changed that much. And we here is more as suggestive evidence using this bound. In the follow-up paper, we further flesh out this point using more estimates motivated by this evidence here to argue that over the long run, the long run liquidity in the stock market has not improved significantly. Most of the improvement in liquidity happens in the high frequency. Okay, so I run out of time, so let me quickly summarize. In this paper, we show that we argue that high sigma p and low sigma q implies a tension between disagreement and elasticity. And if one acknowledges investors disagree with each other, one must accept that flows have large price impact. And we formalize it in a price impact bounds. Empirically, we show that there's a large disagreement in data, so the bound has its bites. And the PQ volatility ratio can be simply used as an easy to compute measure for price impact for sanity check or ballpark estimates. So that's all I want to say. Thank you so much for your time and looking forward to Erik's discussion. I already sense that he's onto some very good points. Let me stop sharing.
Many thanks for Julia's great presentation. It's very clear. Now let's switch to the discussion by Erik.
Okay. Well, thanks, Julie. I don't know about great points. So, okay, so I'm gonna talk about the null. I think I mentioned that. I'm gonna talk about the main equation, and I don't have a lot to say about measurement, but I think this has to be asked. So I think this is something I'd like to think about. Just don't have time to get to. Okay, so the null to me is the no trade theorem, which clashes with like empirical regularity, where there's kind of a lot of trade we observe. I mean, I'm not a commodity trader, but I'm sure it's kind of all hands on deck right now. And so the conclusion from the theory is that there must be disagreement, and I put disagreement in quotes. And that's, again, it's the author's papers, it's their baby, they can name whatever they want. whatever they are, but it's not disagreement as in usually lack of common prior. It's kind of like, all right, just gonna forget, Harrison Krebs. I agree to disagree. It's also, whatever reasons I trade. So idiosyncratic demand that could come from hedging demands, institutional constraints, liquidity, blah, blah. Anyway, so then we have sort of like a triangulation. We have three things. We have disagreement or whatever, motives of tradings, price volatility in the data and trading volume. And somehow, all this put together is going to inform us about something that us as practitioners of finance or academics care about, which is a price impact effect of trade on prices. And like I'll get to why we care about this. Like obviously Julie and I are like on board with this, but not everybody is. But like, why should we care about like answering price impact? Well, because it ties in like elasticity. Elasticity has implications for like existing models of asset pricing, etc. So I care about it. You should care about it. All right, so here's the equation. I'm gonna write things. I actually like I was ranting to my co-author about how like Julie takes like the Kojin. I mean, I have a debate with Kojin Yogo on different things, but like something that I can be vocal and out spoken is that the notations are atrocious, and everybody should follow our notation, which are like better and stem from the French tradition of mathematics, which is just the best. So here it is. Okay, so we have demand curves. Q is quantity, so change in quantity on the left responds to elasticity E, right? It's in the name, E elasticity, not zeta. Like that's not an elasticity. That's just a complicated word. Delta P plus some idiosyncratic demand. And that's something that we forget when we think about, and we always say, oh, elasticity is just the counterpart of price impact. There is a subtlety is that we have multiple demand curves. Everybody has their own demand curve. And so here I can write an EI here, but there is only one price. And so when I look at the effect of a demand shock on the price, there's only one price impact, scalar or matrix or whatever. And that's actually quite important, and the paper kind of hinges on that a little bit. It's saying like, well, there's only one price. Why? Well, in market clearing, not one price. There's no like nothing is. It's not because we said that markets are inelastic that we're revolutionizing the world here, the world. And that does matter quite a bit. And by the way, yeah, M for price impact. Thanks, Julie. This is a good notation because it's a multiplier, and we can use P because it's the price, but M is good. Okay, so from price volatility, I can say something about individual demand volatility. Okay, fine. But from the volatility of all demand shocks, I can say something about aggregate price volatility. And so those two things together is what make the paper work. So here, we have, okay, so the second equation, it's the easiest one. I have like price volatility on the left is basically price impact times the volatility of demand. Okay, fine. That's good. But then, volatility of demand, like, I don't know, like where this is coming from. I don't know really how to measure this. So would it be nice to relate that to the volatility of portfolios or trading or whatnot? And that's what this paper does is really basically like figuring out what this proportional sign means. And so how we get from one to the other. Okay, so it's easier. So my point is that it's easier to measure changes in position. This sigma square Q is really like, you can see that. I mean, at least using the 30NF, you can see some of that. And then with some structure, and then it's true that they don't have to impose a lot of structure, we can sort of recover this proportional factor between demand shocks and position. So the sigma square Q here and the variance of aggregate demand, it's like this row thingy. Okay. And so if you put all this together, now we have the proportional signs like all figured out. And so I can link basically the multiplier, which is the ratio of the vol of the price on the vol of demand. And that's nice because it's now a ratio of two things that I can measure, variance vol of the price over the vol of holdings, times something that Julie is going to did show us that you can also measure this row if you put some structure. Like, you're gonna assume that it comes from disagreement, and then I can go out and pick my favorite disagreement measure. Okay. Now my gripe is that, well, is actually row easier to measure and interpret than measuring individual demand and aggregating it? Maybe. I mean, that's the case the paper is trying to make. So I think I want to be very clear about like, why is this paper interesting is that it's pushing the theories that, look, this thing, that's hard. That's so like, I don't know why people trade. I actually don't, I observe their position, but I don't observe people's trade directly. So it's a little bit of a dark matter to me, but I sort of know, I have information about levels of disagreement roughly. And so it's going to be easier for me to measure row. By the way, Julie, feel free to interject if I'm saying anything like stupid off base. Really. Yeah. Anyway, so okay. Good. Market clearing. Okay, so I said I was gonna do something a little bit with heterogeneity. So imagine that the delta QI, because of market clearing, it's really the distance between how you trade and the average of how everybody trades. Like, it's actually kind of nice to put some structure on individual demand and write, there shouldn't be a comma here, write that your demand shocks basically have a component that loads on like the aggregate demand shock plus an idiosyncratic component. And once you do that, like, oh, how do you change your portfolio? Well, part of how you change your portfolio is how everybody else changes their portfolio with a beta, and then some idiosyncratic changes. And so you can basically decompose disagreement. So you can redo the decomposition. I mean, they do that in the paper, just not with that heterogeneity. But here it's very clear. So disagreement comes from two sources. It comes from cross-section variation in idiosyncratic demand. Okay. And then also sort of like a cross-section variation in loadings. And that's kind of interesting because technically, right, they're going to go out and measure this using like, let's say, disagreement in earnings. Why not? But technically, you could like run regressions here and saying like, look, I kind of know like aggregate flows. I can regress individual like flows on aggregate flows, and that gives me an idea of beta. And I also have some cross-sectional variation in beta, and that's another way of thinking. And it doesn't play exactly the same role here and here, so I think that's something that's like measurable and would be kind of nice to do and kind of easy. And then we learn something, right? We learn like that individual demand is driven by those two components, and we can sort of like regress them. Okay. Now I don't know if I have like any minute, but I'm going to talk about my favorite topic, which is sort of like if you look at my discussion slides, there is always a slide that's monomer specification. This one is like close to my heart in the sense that what happens to multiple asset case? I think like my co-author Paul Rubner discussed that paper. I don't know if like their section on multiple assets predates or postdates that, but they did do some work on that. So I'm still going to talk about the implications. So if you have two assets, your change in position for asset one is basically loads on, how you trade asset one, but also sort of like the shock that I've had asset two. That's sort of like a basic like leakage of substitution. Now, if you put some structure on how people trade in elasticity matrix, you can like solve for the problem and say, oh, my change in the demand here for asset one is my idiosyncratic demand for asset one, plus a mix of the aggregate shocks on asset one and asset two. And so now when you're taking the variance of this and you're looking for your sort of like row, it gets kind of messy because you have the cross-sectional variance on idiosyncratic shocks, the variance on the loadings, on the aggregate shocks, both of them, that should be S here actually. And then the covariance between those shocks, which is kind of like, and by the way, that's just for two assets, right? Remember that there are like basically like 3,000 traded stocks on the US stock market. So it gets a little bit tricky, and they do some attempts to think about this, but the issue becomes like it's really hard to interpret what M is for. I mean, obviously in our paper, we try to say like, oh, what is that M good for? But it's kind of shifty, right? When you move to a multi-asset world, because like the main price impact equation is sort of like a matrix equation here. And your bound might recover something, but not really like this first like element M11, but some linear combination. And I'm not saying the paper is doing like a bad thing, but I think they could highlight like, oh, how is that useful? Like that bound that recover in the sense that which question is that bound the answer to? In a single asset case, very easy and clear. In the multiple asset case, I mean, it's the question to, it's the answer to a question. It's just not, the author just like need to write the question. They have the answer, they just need to write the question. And last, what is rho? Well, it's a mix of it, and I think that's what Julie wants to go with the bound, because then, they're like, well, we have part of rho, we don't have it all, so, that's just the bound. But we are scientists. I don't want a bound. I just want an equality. So what's missing for it to be an equality? Right? It's a mix of idiosyncratic demand, and again, you kind of tackle the prior, but what about liquidity hedging? Why are you focusing on one source of heterogeneity? What would be like, I'm not asking you to do everything, but like, what can you speculate on other sources of heterogeneity? Like, is disagreement the main source? Like, is that bound tight in any sense? I know you're saying like, well, it has to be tight because it matches other. Yeah, maybe. Good. Thanks.
Hi, Julie. Do you want to take a minute to respond?
Cool. We are running out of time, so let me very quickly respond to several points. And thanks for the discussion. It's, as I expected, many good points, many great points. I'm not going to respond to your question about notations, but I like to say that's great. And so second, let me, in the reverse order, on the multi-asset case. And actually, thanks to your paper's motivation, actually after the post discussion, we added the whole multi-asset case. And so the very quick response to your point is that M is still the same M. We still recover the M11, but the rho is no longer the rho of the U1T. Like, it's not only about the rho for this asset, but it's about how strong investors feeling about substitution between this asset and other asset as well, and how strong is the demand, the price coming from the other asset. So in a world where even people disagree a lot about this particular asset, but there's a strong substitution out there, and people agree with how much substitution is, like say there's no arbitrary condition, then the rho will be very high, and then our bound will not be applicable. In that sense, that probably in our current writing is not super clear, and we're currently revising on this one. And actually, Erik, can you go 3 slides earlier? Just want to see, I think there's one point I want to mention. Oh yeah, it's basically on the rho measurement point. Yeah, so I'm happy you didn't ask us to do everything, but referee basically asked us to do everything, and we are trying to measure as much as possible the rhos, and are from all sorts of different sources. And it's very hard because rho really comes from very various sources, like reservoir regulation, etc., etc. But I think the bar for us is not that high because we don't want to pinpoint the rho. All we need is to see that rho is not in some extreme. And then as long as it's not in the extreme, which is something that we can show that in the data, the rho is reasonable across all sorts of different sources, then taking into all these form of heterogeneity, the rho is still in the reasonable range, then we can still apply the bound. Oh, no, yeah. And one last point on your point of the putting factor structure on the U. We seriously look into it this direction, and then the outcome is that we basically reinvented GIV. The only way to if the factor is not directly observable, but while we try to put on the factor structure on U and to extract the factor at the same time to estimate the rho, the only way to do that actually becomes GIV. And we decide in this paper we don't want to go that structural, so we leave that out. Okay. Oh, that's all I want to say.
Okay, thank you very much. So, do we have any questions from the floor? If we do not, I have one more question. Is how do you see the application of this? How do you see how your paper is going to motivate for future research, or particularly in international? Yeah.
So on international finance side, there's one question, which is the volume is huge in the foreign exchange market. You read every paper about foreign exchange market. The starting point is, foreign exchange market, the largest market in the world, and with daily volume becomes more than 8 trillion. But if you look at the price impact estimates across various studies, the price impact is very large. Typically, it's several 2-digit billions move $1 per for 1%, which is, if you think about it, daily volume is at trillion level, while the price impact is that large. It just doesn't square together. So this is a point that actually I think the bond can be perfectly useful, which is how large is the real net volume out there? Like net volume defined as portfolio flow volatility, the end-to-end rebalance in the portfolio, as opposed to the round-trip trading. If we can figure that one out, we can now get a ballpark estimate of how large is the flow volatility really out there, and use a bond to get a sense of what should the reasonable ballpark of the price impact should be, and what kind of role needed to be justified to justify the high price impact we observe in the world. So the overall view of my overall view of this bond exercise is that it's not the end of the story, but it's a very good motivating evidence for us to look into many aspects. For example, the long-term liquidity provision, the short run versus long run, and many other aspects on this. Yeah.
Okay, thank you very much. That sounds very interesting to explore. If there's no more questions, let's just conclude here today. Thank you again to Zhiyu for the presentation and Erik for the great discussion. Let's just finish here, and I wish everyone have a good weekend. Thank you.